The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin, Jeong. U.S. equities are trading at some of their richest valuations in decades, levels last seen during the pandemic and the dot-com bubble. Yet this elevated pricing comes against the backdrop of modest economic growth, a manufacturing sector mirrored in contraction for nearly 3 years, and housing activity weighed down by high mortgage rates. The disconnect is being masked by the boom in artificial intelligence capital spending. So how sustainable is the rally? What are the risks investors should be watching, and how best can you position your portfolios in the months ahead? Well, to find out more, I'm joined by Tim Murray, who is a CFA and capital market strategist at multi-asset division at T. Rowe Price. Hi, Tim. Welcome to the show.
Thank you for having me.
Thank you so much for joining us. Well, Tim, the forward PE multiple of the S&P 500 is hovering near historic peaks, even though the broader U.S. economy is showing only modest growth, and several sectors like manufacturing and housing remain weak. So how sustainable do you think current U.S. stock valuations are, given this, discount between market pricing and underlying economic momentum?
I think it's actually quite sustainable. The U.S. economy right now is, as you mentioned, it's really bifurcated right now. You have the majority of the economy, particularly housing and manufacturing, which are quite weak and have been weak really since late 2022 when the Fed started hiking rates. And then you have the part of the economy that is levered to the AI build out. That's part of this big ecosystem of building out the infrastructure to do AI. So that data centers, the connection to the data centers, the power, producing the energy to power those data centers, and then all the chips and processors that go into all this. That part of the economy is absolutely booming. And the S&P 500, if you look at the S&P 500 and the makeup of that index, it's actually probably somewhere, depending on how you measure it, somewhere 30 to 50% of the stocks in that universe are really highly levered to that build out. So even though most of the economy is weak, the makeup of the S&P 500 means that you've got really strong growth in those companies. And if you look at the underlying numbers, the profitability of those companies, revenue growth of those companies, it really does justify these really high valuations right now.
Okay, so is this valuation defensible if economic growth remains modest?
Yeah, I think I would say it is certainly defensible as long as the outlook for the AI sector remains really strong, as long as they continue to deliver on at this point, AI, I would say, is about promise and progress. There's a lot of promise about what it could be in the future. And while these companies don't necessarily have to deliver great profits at this point, they definitely have to show progress towards that promise. So as long as that stays intact and you don't have a recession in the broader economy, the broader economy is just weak but not recessionary, then I think the valuation can really be defensible and can be sustained.
Well, the ISM manufacturing index has been below 50 for nearly 3 years, something typically associated with recessions. Yet it looks like equity markets are still trading near record highs. So does the persistent weakness in manufacturing signal risks that equity markets are ignoring, or has the market effectively decoupled from these traditional economic indicators?
Yeah, I would say to a certain extent, maybe the market has decoupled from those indicators. I wouldn't say necessarily that the market's ignoring them, because if you look under the hood, the companies that are more levered to kind of traditional manufacturing don't have nearly the valuations that other part of the S&P 500 have. So it's not that the market's ignoring them. So I wouldn't say they've decoupled, but it's just that that part of the economy has become less important. Like I said, as long as that part of the economy doesn't become recessionary. Mm-hmm. Right now, you're making progress in manufacturing. The last few numbers have been moving upward. And as long as that ISM manufacturing number stays above 45, that's generally the kind of the soft landing territory. So as long as we stay there and we start to see those numbers get better, they're closing in on getting above 50, and it would be nice if they kind of got above 50 and stayed that way. And one driver of that we could see developing is the Fed cutting rates. So I think you have to pay attention to those traditional economic measures just from the standpoint of recession, but there's reason to believe that they're going to continue to improve and finally get out of that soft landing territory.
Well, higher for longer interest rates have weighed heavily on housing and other sensitive sectors. But I mean, these pressures have not derailed market performance. So should investors be, concerned that these lagging sectors could eventually spill over into broader market fundamentals? Or will AI-driven growth continue to offset those risks?
Yeah, I think it is something that is a concern. At some point, the fact that kind of the broader economy is weak, especially if that starts to bleed into the consumer spending, because ultimately the AI spending is being done by the hyperscalers, and they get a lot of their kind of core revenue from consumer spending. Amazon, Meta, Google, these are all companies that generate a lot of their revenues from consumer spending in the digital world, and on offline or online retail for Amazon.
Right.
So, yeah, if you start to see this kind of broader weakness tip over into the consumer, that's when you need to be concerned. But so far, we haven't seen that. And if the Fed does continue to cut, I think, and the labor market stays relatively healthy, then we should be okay.
AI spending has been a powerful driver of earnings growth, largely concentrated in a few mega-cap tech firms. Now, these firms have been able to fund their investments internally, avoiding interest rate headwinds. To what extent is the stock market's resilience overly dependent on AI capital expenditures then, Tim?
To a very large extent, is what I would say. It absolutely, at this point, is all about those capital expenditures. They have to be sustained in order for the stock market's resilience to continue. That said, I think there's a very high chance that they will be sustained, at least for the foreseeable future. These companies have decided that they absolutely have to win the AI race. It's imperative for their businesses to remain strong. So they're going to continue to spend, absent some really surprising shock.
Okay. Then what risks emerge if the hyperscalers begin to scale back or face regulatory hurdles?
So the first thing I would say is facing regulatory hurdles is almost no risk of that. This current administration is 100% committed to winning the AI race, to making sure that the U.S. is a leader in AI and kind of wins the so-called AI race. So that's not something to be concerned about. If the risk that would emerge is absolutely that we would see valuations come down pretty sharply. I mean, it's the kind of positive feedback loop that has come from the hyperscaler spending, the market believing this is going to be effective and profitable spending ultimately, down the road. That's what's driven valuations higher, because that's also essentially fueled the really strong earnings that the actual companies doing this AI production, producing the chips and the data centers, et cetera, it's fueled those profits. So if they scale back, then those profits go away. And only reason they would scale back is because they've decided that this isn't going to be as profitable as they thought. So there's a lot of risks to valuations, to earnings, if they do feel like they have to scale back. But again, that looks like a very low probability at this point.
Much of the recent market strength has come from a narrow set of large cap tech companies, while, many other sectors lag behind. So how concerned then should investors be about the narrow breadth of the rally, and what would a healthy broadening of market participant look like?
Yeah, I think it's something you do have to be concerned about. I would say particularly you should be concerned about the labor market. That's something that we've seen some weak data there. When we dig into it, and I think most economists would agree, the weakness that we've seen in the labor market doesn't appear to be a recessionary signal at this point. It just appears to be kind of some weakness that hopefully is going to fade soon. That said, if we do get kind of a broadening, that would be based on, I think, the Fed cutting rates and the housing market kind of picking up thanks to that. And also potentially there's some levers the Trump administration could pull. They recently declared a housing emergency, and there's some things that they might be able to do to get mortgage rates down even further. And if that happens, I think that's when you get a broadening rally. And what it would look like would be that you start to get value and small cap to perform really well. So if we get this kind of broader strengthening of the economy, that's where the upside is. It's in value and small cap and less in the growth stocks that are already really strong because they're so levered to AI.
I mean, analysts also warn that if fundamentals weaken, the downside could be, sharper than usual because valuations leave little margin for error. So what leading indicators or signals would you watch most closely to assess whether fundamentals are deteriorating and downside risks are intensifying?
Yeah, unfortunately, there's not a lot of economic data that you can look at. The one area, like I said, would be the labor market. That's something that you want to pay attention to. If you start to see really negative numbers, not just kind of positive but weak job creation, then that would be a concern if it starts to go negative. Outside of that, it's really going to be down to the earnings calls of the hyperscalers. What are they saying about their CapEx spending? Are they going to continue? So far they've been saying, yes, we're going to do this, and we're going to do more. Every earnings report just about they've said, yeah, we really believe this is going to pay off, and we're going to continue to do more and more. If that were to change, I think you'd start to be worried. And also, I think some key metrics might be profitability-oriented metrics for the S&P 500. So if you start to see profit margins go down, if you start to see return on equity go down, those would be warning signs that you want to pay attention to.
Well, despite high valuations, some are holding a neutral stance rather than, overweighting on U.S. equities. So what are the main arguments then for maintaining a neutral weighting in U.S. equities today? And under what conditions would you, pivot toward a more defensive allocation?
Yeah, so we're doing that in our asset allocation portfolios. We're maintaining a neutral stance. And the reason why is that while the risk return for equities, the upside versus the downside isn't particularly strong right now, right? There's a lot more downside because of those high valuations than upside. That said, as I've been kind of outlining, the likelihood of continued strength in the AI ecosystem is really high at this point. So the argument for staying at a neutral weight in equities is that while you have on the one side not a great upside-downside ratio, on the other side, you have a really strong outlook and a really high likelihood of success there. So that would be why you want to not go underweight equities despite these high valuations. What conditions would you pivot toward more defensive allocation? I think it's if you get any hint of, as we've talked, if there's any hint that the hyperscalers are going to have to pull back on spending, if there's any hint that the labor market is going to turn into a recession, if there's any hint that the Fed has to stop cutting and start hiking again, which would then be really bad for manufacturing. If you see the ISM PMI go down below 45, all of these would be signs that you would want to turn to a much more defensive allocation.
All right. Well, thank you so much, Tim, for your time and your insights today.
It was a pleasure to be here. Thanks for having me.
Thank you. That was Tim Murray, CFA and Capital Market Strategist at Multi-Asset Division at T. Rowe Price. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.